Jeremy Grantham has an argument about the AI bubble that sounds almost backwards.
A bubble is a kind of faking out. Not at all. A bubble is associated with really powerful, real ideas. And the more obviously powerful the idea is, the more likely it is to be a bubble.
And that distinction matters, because most conversations about an AI bubble get stuck on the wrong test. Someone points to a useful coding agent or a company saving money in customer support and says, look, this is nothing like the dot-com era. The product works. Fine. But a useful technology, a profitable company, and a good investment are three different outcomes. Grantham made his career studying and betting against market manias. That gives him a memorable way into this question. It does not make him automatically right. Famous bears can be early for years. They can mistake an expensive market for a collapsing one, and they can keep repeating a warning until the calendar finally rescues them. So I don't want to make a video that says Jeremy Grantham called it a bubble, therefore it is one. I want to take the strongest version of his argument and try to break it. If AI demand is real, if the revenue is real, and if the technology keeps improving, can the investment still fail?
The strongest answer is sitting in the company's own results. In April 2026, Microsoft said its AI business had passed a $37 billion annual revenue run rate. Azure demand was still exceeding available capacity.
Cloud significantly accelerated, with revenues growing 48%, now on an annual run rate of over $70 billion. Backlog grew by 55% quarter over quarter to $240 billion, representing a wide breadth of customers driven by demand for AI products.
That is not a pre-revenue startup buying servers with a pitch deck. Alphabet is one of the most profitable companies ever built, serving customers who are already paying. Microsoft is seeing the same basic pattern. And that makes the capital spending less absurd than it first looks. Microsoft expects roughly $190 billion of CapEx in calendar 2026. Alphabet expects between $175 and $185 billion. But those numbers support more than one model or chatbot. They include cloud capacity, networking, buildings, existing products, and infrastructure that can serve many workloads. If customer demand is larger than available supply, building more supply can be exactly the rational thing to do. So high CapEx does not prove a bubble. A rising stock price does not prove a bubble. Even aggressive forecasts do not prove one. The unresolved questions begin after demand. How much capacity will remain full? What price customers will pay? How fast the equipment becomes obsolete? And how much of the value created by AI the infrastructure owner can actually keep? The bull case is real. That is what makes the next part interesting.
Suppose you run a large cloud company and believe AI demand will be enormous. Waiting for perfect evidence is not a neutral choice. A data center takes years to plan and connect. Power can be scarce. Advanced chips arrive on someone else's schedule. If your competitor reserves the capacity first, you may discover the market was real at the exact moment you became unable to serve it. So you build before all the demand is visible. That decision can be correct for you and dangerous for the market as a whole. Your competitor sees the same model improvements, the same customer experiments, and the same supply constraints. It reaches the same conclusion. Then the model labs, data center operators, utilities, chip suppliers, and private lenders all plan around versions of the same upside case. Nobody has to be lying. Nobody has to be irrational. Each player is protecting itself against the cost of being late. The problem appears when the protection is synchronized. Everyone reserves more capacity. Everyone assumes usage keeps compounding. Every sign that AI works raises both expected demand and the fear of missing it. A weak technology would kill the spending quickly. A credible technology keeps every participant at the table long enough to build something much larger. Real demand can justify investment. It cannot tell you in advance how much industry-wide capacity will eventually be too much. Grantham adds another pressure that I think is more important than the usual bubble language.
Instead of having monopolies, you have an unmonopoly. You have a fight to the death. Capitalism red in tooth and claw. This is going to be it. Lots of blood.
For much of the last decade, the largest technology companies earned extraordinary margins in different territories. Google dominated search, Meta dominated social advertising,
Apple controlled a hardware and software ecosystem, Microsoft owned critical enterprise distribution, Amazon built e-commerce and cloud infrastructure. They competed, but they were not all attacking the same profit pool in the same way. AI changes the geometry. Now the same companies are building overlapping models: cloud capacity, developer platforms, agents, consumer assistance, advertising tools, and enterprise software. Each believes AI could threaten the business that currently funds everything else. That turns investment into defense. You may spend $200 billion because the return looks attractive. You may also spend it because losing the platform shift would damage the rest of your company. Those motivations produce very different economics. A market of separate toll roads can support several owners with pricing power. Put the same owners on one road, chasing the same customer, and their spending becomes somebody else's bargaining power. Customers can switch models. Enterprises can negotiate across clouds. Open models can reduce the price of a capability that was scarce 6 months earlier. AI can expand the total market, while competition reduces the share any one company keeps.
This pattern is older than software. Railroads changed the physical economy. Investors were right about the importance of moving people and goods faster. That obvious importance attracted competing lines, overlapping routes, and capital that many owners never earned back. The internet did the same thing. It became more important than even the optimists expected. That did not prevent telecommunications firms, infrastructure projects, and thousands of internet companies from destroying investor capital along the way. There is a useful NBER paper by Lubos Pastor and Pietro Veronese that models this problem without assuming investors are idiots. A new technology arrives, its eventual productivity is uncertain. The economy learns by adopting it. Good news raises expected cash flows, but large-scale adoption also changes the risk carried by the entire economy. The resulting price path can look like a bubble after the fact, even when nobody expected a crash beforehand. The pattern becomes more pronounced when uncertainty is high and adoption is fast. That is almost a description of why this debate is so difficult. You cannot observe the final market from inside the build-out. You only observe improving models, rising usage, new customers, and competitors moving faster. The infrastructure left after a bust may still be socially valuable. The fiber still carries data. The rail still carries freight. Cheap excess capacity can accelerate the technology after the original owners lose. Technological victory does not reimburse every investor who financed the path.
One of Grantham's best examples comes from his own career. His firm bought an expensive computer when few competitors had one. For a short time, faster calculation created an advantage. Then everyone bought a computer. The machine did not become useless, it became necessary. What had been a competitive advantage turned into a normal cost of doing business. AI could follow the same path. If an agent saves your company 10 hours of work, that is real productivity. If 5 providers can deliver the same result and keep cutting prices, much of the value stays with you, the customer. William Nordhaus studied the difference between the total social surplus created by innovation and the fraction captured by the innovator as excess profit. Competition, imitation, falling prices, and better products can transfer most of the benefit away from the company that made the original investment. AI may make this gap wider. Intelligence is expensive to develop, but increasingly cheap to reproduce. Better models help build competing software and even competing models. The capability spreads while the toll charged for each use falls. Some firms may still protect exceptional profits through distribution, proprietary context, switching costs, chips, energy, or customer ownership. But that is a market structure argument. It does not follow automatically from the technology being useful. Society can receive a productivity boom. Customers can receive cheaper services. AI usage can explode, and an investor can still earn an ordinary return on extraordinary capital.
Now we can make the investment risk concrete. A data center building may last for decades. The processors inside it do not. Microsoft said roughly 2/3 of its quarterly capex was going into short-lived assets, mainly GPUs and CPUs. Alphabet said its 2025 depreciation expense had risen 38% and expected depreciation growth to accelerate as new infrastructure arrived.
Density that's going to be so different, but with cooling requirements that are going to be so different, right? So you kind of don't want to just build all to one spec. So that goes back a little bit to, I think, the dialogue we'll have, which is you want to be scaling in time, as opposed to scale once and then be stuck with it.
That creates a race. Capacity has to be installed, powered, and filled fast enough to earn a return before newer chips, cheaper models, or lower prices change the economics. Falling costs can be excellent for demand. Alphabet said it reduced Gemini serving unit costs by 78% during 2025. If usage rises even faster, the economics can improve. If customers capture the savings through lower prices, the same efficiency can expand the product while compressing the return on older capacity. Financing changes the downside. The Bank for International Settlements says future AI investment needs are likely to push more financing from operating cash flows toward debt and private credit. Debt converts a wrong forecast into a deadline. None of this guarantees a crash. The largest buyers have cash, customers, and infrastructure that supports more than AI. The BIS currently describes the broad financial stability risks as moderate. But the hinge is visible. Revenue can arrive more slowly than capacity. Unit prices can fall faster than usage rises. Replacement costs can reach the income statement before new products reach durable scale. And specialized assets financed with debt can become difficult collateral when the preferred hardware changes. AI can work through every step of that failure path. Imagine a strange version of 2029. Models are much better. Agents complete useful work. AI is inside almost every office product. The price of intelligence, measured per task, has collapsed. Usage is enormous, but capacity built for premium-priced intelligence is earning commodity returns. Some model labs merge, some data center projects are canceled. Hardware orders fall for several quarters. Owners refinance assets on worse terms. Investors mark down companies whose growth was real, but whose margins were not. The public says the AI bubble has burst. Then you open your laptop. The AI features are still there. They're faster, cheaper, and used by more people than before. That outcome would not mean the technology failed. It would mean the price paid for part of the capital stack assumed a scarcer, more profitable future than the one competition produced. I am not predicting that exact sequence. It is a stress test. If your definition of AI success requires every model company, hyperscaler, data center owner, chip supplier, and lender to earn exceptional returns, you are asking one technology to protect too many profit pools at once. Capability can rise. Adoption can rise. Consumer surplus can rise. The return on a particular factory, loan, stock, or model can still fall. Once you separate those curves, the bubble argument stops being a referendum on whether AI is real.
So what would tell you whether the build-out is growing into its valuation or growing past it? I would watch 4 things together. First, utilization. Does new capacity fill after it comes online, or does the shortage disappear faster than expected? Second, depreciation and replacement cost. Is durable AI revenue growing faster than the expense of replacing short-lived compute? Third, unit price relative to usage. Falling prices are not automatically bearish if usage grows faster. The danger is when revenue per unit falls faster than volume expands. Fourth, paid customer revenue that survives the experimental phase. Are customers still spending when strategic credits, introductory pricing, and fear of missing out matter less? No single earnings call settles this. But these 4 numbers show whether the industry is converting learning into cash flow, or converting cheaper intelligence into cheaper intelligence faster than it converts it into profit. That is why AI is real does not answer the bubble question. It tells you the market may be enormous. It does not tell you who owns the scarce part of it. And that is the next episode. When intelligence becomes cheap, where does the value go?